Yeah, I spent all this time searching for another life. Had me turning on my purpose, I did nothing right. Sometimes it takes the dark to get you close to light.
What is up, guys? It is Joe Caruso here, and I want to talk today a little bit about do not trade scenarios. So, here in Phoenix Trading, we have something called do not trade scenarios. Now, many of these are concrete, set in stone rules and examples of which, no matter the case, minus maybe the 2% of exceptions that there may be, especially if there's something significant on a higher time frame. But for 90 something percent of the time, you will typically want to stay away from these scenarios. So let me show a couple of them to you. All right. So, good example of do not trade scenarios is going directly against market structure. An example of this. So let's highlight going against structure. If you market is building up, higher low, higher low, higher low. Here, let me just remove this off of here real quick. There we go. Now it's a little more clean. If market is building up, higher lows and tapping into equal level resistance, you do not want to trade against that because market structure, think of it as, let me draw a line here and I'll help replicate it with another example. If this is your resistance and you have your first drive up and now you have this, 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 think about pressure, right? Think about pressure and you have a room filling up with water, right? So a room is filling up and you have a hatch, you have a door, you have a window at the top. As the water pressure rises, the pressure from the water pushing up is going to bust through that window, that door, that ceiling. Same thing with momentum and price. You do not want to sell a equal level resistance against higher lows, vice versa. So alternatively, you don't want to sell same level of support if lower highs are being made. Structure will often give you the clue. You know, as far as if you take these trades, there's a good chance you're going to lose, maybe break even if you're lucky, but there's a low probability of these trades playing out. So you have this scenario of higher low, higher low, higher low into structure. Understand that your first drive is always the best one to take. So if you have some confluence, 50 moving average, let's shark fin divergence. Let's say you have something lining up. That first drive that's coming off of a strong push is always better than taking it against a higher low, because now there's a reason for price to bust through, and what you want it to be a sell will actually end up making a strong buy once that area breaks, and because it's a significant level. If it continues to hold up, you'd actually want to take it on the flip side and say, hey, I don't want to sell this anymore. What I want to see is break and retest. So typical do not sell scenario. Right over here we have equal level resistance that kept getting tapped, tapped, tapped as your higher lows were coming higher, higher, higher. Notice even that when it tapped the 50 moving average, it also went right through it, had this little pullback. And like I was talking about, what you wanted to be resistance actually flipped into support, and then it created. So let's look at this repeat throughout the trend. Equal level high. This is actually a very significant level based on past. So now you have a new high was made, right? So I'm going to go here so you understand we're just talking about this trend. You do not sell here. Let's label them, right? So you would not try to sell here. We're going to say do not sell. And now we're going to duplicate this one. And where's our next one? Right over here. Why? Why do we not sell this? And I'm saying do not sell. This is a very generic scenario, but understand that you can have a shark fin happen at this location. You can have a divergence happen at this location. And in the majority of scenarios, you will never want to take the sell. If you're at a higher high and it's equal level, there's a very select set of confluences that would have to be present for me in order to take them. And yes, I have taken trades that were at higher highs, lower lows, and they were the entire reversal of trend. But that is very unusual, and certain time frames need certain confluences before I would even consider taking a trade like that. Majority of the time, you do not want to sell equal level high against a higher low. So again, this is on a grander scale. So now I could pull this trend line higher to help highlight that we are making higher low, higher low, higher low. We are now rising off of structure. So whether this 50 MA was here, or whether the 50 MA was, let's say, for instance, up here, you would still not want to sell that even if there was a 50 moving average there, because higher lows and higher highs will beat a resistance, a sell at resistance, majority of the time. Now, this exact same scenario that we're talking about happened again in the same trend, but higher up. So right here, you do not want to sell the equal level highs going against the trend. Why? Because we made yet another higher low. Higher low, higher low, higher low. Can't really connect them all with a clear trend line, but you have this buildup of higher lows going against your ceiling, and every single time, higher low breaks the ceiling. Higher low breaks the ceiling. Sometimes you're lucky enough to get a little move off of it, where it may play out, but I'm telling you, in the long run, this is going to be your friend. Following this methodology of do not take blatantly counter trend moves without the proper lineup. Structure will win the battle, whether there's a 50 MA, whether there's a shark fin, whether there's divergence. You have to be very careful about higher lows into equal level structure, or lower highs into equal level structure. So that is one of your main do not trade scenarios. Another do not trade, it highlights along the same path, is do not blatantly go against a higher time frame move, right? Higher time frame moves are powerful, and if they have not played out, you do not want to trade directly against them. An example of this is right here. You have daily shark fin. So if I'm just going to clear everything off of here, you have this move, daily shark fin. So whether it was this touch or this touch, it's fine, doesn't really matter the touch. What you're highlighting is if your daily is a shark fin or divergence, and it's highlighted on our indicator, right? We have a special custom indicator in Phoenix TDI. Our Phoenix TDI shows us divergences and also shark fins. So it highlights both shark fins and divergence all along the TDI wherever it's present. So we can see that shark fin divergence on the daily. What you have to understand is that move, that's a move, right? And that move has a take profit. And majority of the time, these moves will play out. So if you can gauge, okay, shark fin at the 200 / divergence on the 200, however you want to count this, depending on where you took it, the take profit of that move is the 50 moving average. This means that until that hits the 50, you will look for buys. Once it hits the 50, you can consider sells. I'm not saying you should always sell there, but that's the take profit of the move. Using this methodology, this is why we will trade whether a market is bearish. We can take trades whether it's bullish. When you can identify where a market is in its trend, it does not necessarily matter whether this was overall bearish, right? Based on this big drop on the daily, we were still okay to look for buys, especially at the time it came down. It was definitely bearish, right? You had lower high, you had support broken. It created this significant low down here. So you didn't really know it was bullish until much higher up, but I'm saying it does not matter, right? When you're trading, if it's every time frame does not have to be bullish in order to buy. Every time frame does not have to be bearish in order to sell. You can identify, especially with the strategy, where market is not just in its trend, but what move it's currently in. Shark fin up top here. What does that mean? Where does the take profit of a shark fin at a high go? 50 moving average. So I'm going to highlight this one green and this one blue, or this one. Yeah, I'm going to change the color. Let's do the shading as green. Green for buys, red for sells. This zone on our lower time frames, we would only consider sells because we know majority of the time the shark fin will get you to that 50 moving average. And it's actually the same zone that we're looking at. Once it hits that 50, all bets are off. It could buy, it could sell, anything can happen. But that's understand that you only want to trade when you have a very good understanding of what's going to happen next. So now that you know a lot of these common do not trade scenarios, you know that no matter what happens in your buy zone, you are not going to sell, regardless of you seeing afterwards that maybe one would have worked out. Majority of the time, if you try to counter this, if you try to counter a daily shark fin and say you're going to buy a 4-hour 50, a 1-hour 50, you will majority of the time lose that trade. Your explanation always lies in the higher time frame as to why you lost for majority of the trades. You look up and you're like, oh, this was counter trend. Oh, this was against the shark fin. This was against the higher time frame divergence. What was I thinking? So you always want to be aware of higher time frame first, and then let that help you with which way you're going to trade on that pair. Does not matter that Euro JPY was very, very bullish. Once that shark fin was created, you had to then use the logic of, okay, this thing is probably going to play out. And now I will not touch buys again until at the very least the 50. You have to let it play out. Do not try to counter that move. And in this example, in this exact scenario, you'll actually see that there was potential for buy, there was potential for sell, but there's plenty of examples where it will go through everything that you see, no matter how good it lines up on your 1 hour, 4 hour, 30-minute, even if they all line up together. If that daily says otherwise, it's that higher time frame is going to win the battle. So you see these examples of like, hey, daily divergence came down, hit the 50. You'll see this higher time frame repeat over and over again. And if you want to increase your win rate, if you are tired of losing as many trades as you are losing and you want to change, you have to incorporate something to help weed out the bad trades. That's the problem with people who just trade price action compared to those of us who use indicators. We have a much more in-depth, thorough way of screening trades. Okay, does this go through this filter, this filter, this filter? So understand that when I enter a trade, it has gone through a process of filtering through from the daily all the way down to the 30-minute or 15. Those timeframes have all been scanned, and I'm looking at the same 3 indicators on all of those timeframes as filtering process to help pinpoint my entry, to help with stop loss, to help with take profit, to help with should I even take this trade, right? When it all lines up, that's how we're entering. So difference between when it all lines up for me and when it all lines up for someone who only trades price action is there when it all lines up might just be a break and retest with an engulfing candle, right? My when it all lines up is going to be shark fin divergence combination on multiple time frames. Structure could be trend line, fib level, Bollinger Bands on multiple time frames, maybe just one, but I'm having multiple indicators, multiple time frames all coming together, and the trade has to make sense on a higher time frame, either at a higher time frame area of interest or in the direction of a higher time frame, right? That's a quick summary of how this all works and how you go from trading with uncertainty, trading without confidence, to learning how to trade with confidence, how to enter a trade and know that there's a very good chance of this trade playing out, which in fact is the only time you should ever be entering a trade is when you have a good understanding of what's going to happen. We're not in this to play the guessing game. We are in this to learn a way in which we can have an edge over the market to get the odds in our favors. A quick comparison is a casino is set up to be profitable long term. However, in one single day, you may have somebody who hits the jackpot for millions and millions of dollars. And for that day, the casino might actually not be profitable. But tell me this, when somebody wins the jackpot, when somebody wins in a poker, when somebody wins against the house, does the casino change their entire game, their entire rule set, just because one day they were not profitable? Right? Consider how casinos work, why they work so well. They are keeping the odds in their favor long term. That's what you're trying to do with trading. It's not so much about this trade or that trade has to work, or if I had one loss today, but it's about in the long term. That's why I'm teaching methods that on a day-to-day basis will still work majority of the time, but they work especially well in the long run, right? Waiting to go along with higher time frames, only trading in the direction of higher time frames, either at areas of interest or while it's in a move. That on a trade to trade basis, you might miss some trades by not taking them due to discretion. But in the long run, which is the most important thing, it will keep you, make you and keep you profitable. So remember, it's all about getting the odds in your favor, which indicators give you now several more reasons to get the odds in your favor. Understanding higher time frame basis helps get the you want to gather all of this, right? And when it all comes together and you have this location where so much is lining up, there's so much evidence that it should go in one direction, then you're ready to look and take a trade. So do not trade scenarios are very, very helpful in understanding the overall bias, the overall direction, and cutting out just some of those silly losses that sometimes, you could take 2-3 losses in a zone where you should have not even taken one, because it was clear as day that you shouldn't have been there. So hope this video helped clear some things up, gave you a bunch of examples of do not trade scenarios. Now utilize this. Don't just use it right away. Pull up a chart, back test it. See make sure that it's not just, oh, I heard this and now I'm doing it, but you want to see it and then believe it yourself. So you have to do the homework, just like with anything when it comes to trading. Regardless of what somebody says, you have to internalize it and believe it yourself. That way you have the confidence when executing it. So should help you guys. And thank you guys for watching this video. There's going to be a lot more content like this coming out. Now remember, if you are interested, I do live trading and education for 2 hours a day, every single day. I'm going to post the link to my link tree in the description of the video if you guys are interested. I also have a Discord where all my education, all my community, all my resources is put into one spot. So those are the 2 main services that I'm offering at the moment: daily live trading and signals, and education community resources, all in one spot for one price. So hope to see some of you guys there. Feel free, if you have any questions, comments, concerns, please reach out to me or leave a comment on this video. Appreciate all of you guys, and I'll see you guys again soon. Thank you.